All right, what is going on today, ladies and gentlemen? I wanted to take a moment today to talk about this headline from Goldman Sachs, all right, which may actually be more important than you think. Today, I'm going to talk about risk adjusted return, which is not something that individual stock investors can perhaps should be. And I want to talk about what's going on in the minds today of professional portfolio managers and where money flows are likely to happen here going forward for the rest of the year. So this is a really short article. It's just about a page long, basically saying that stock market is basically going nowhere for the rest of the year. This is from a well-followed Goldman Sachs equity strategist, guy named David Kostin. A soft landing, in fact, above trend growth is already priced into U.S. equities. Valuations are elevated versus history and will be constrained by an eventual rise in interest rates. Even avoiding recession, earnings are unlikely to grow substantially in 2023. I've been talking for a long time about this phenomenon, guys, talking about when interest rates rise beyond a certain point, that there are many investors going to choose to go the safe route rather than taking risks in stocks. And a lot of this is institutional investors as well. And it has to do with something called risk adjusted return. And it's kind of a boring subject for YouTube, but it's really important for understanding money flows in the economy. So basically, Kostin lifted his year-end S&P 500 price to 4,000 from 3,600. It's currently trading at about 4,100 right now, and it's had about a 7% solid year-to-date rally. The closely watched strategist said that alternatives to U.S. stocks, such as non-U.S. stocks, credit, and cash, offer superior risk-adjusted return prospects. And I'm going to sort of quantify that today in sort of exactly what that means, because when you look at the NASDAQ composite being up 14% and the Dow Jones being up 3% and the S&P 500 being up 7% or so, this perspective may take you by surprise. But if you've been paying attention to sort of the things that I've been saying about rising interest rates over the years, it really shouldn't be taking you by surprise so much. As the value of a risk-free return starts to rise, the interest in stocks starts to wane a little bit. And by risk-free return, I mean short-term treasuries. Okay. So for starters, the Federal Reserve is off another interest rate hike as it continues to try and combat inflation. And we are seeing some positive news on that front. We've definitely seen inflation stop rising and it started to retreat a little bit here. And while the Fed is widely expected to pause interest rate increases this year, the timing is wildly uncertain. I would agree with that. And that leaves investors staring down the barrel of a potential multiple rate increases this year that would have the effect of slowing the economy and compressing stock valuation multiples, which means that the amount of return you need over that risk-free return needs to be higher, meaning it's going to knock a lot of stocks out of the running. And when I say a lot of stocks, we're going to take a look at sort of the risk-adjusted return of the S&P 500 and the NASDAQ 100 over the years. And I'm going to show you that right now those calculations aren't looking good for the future. That's not to say that some individual stocks on any one of those indexes might not do very well, blowing away risk-adjusted return. But it may be that the index as a whole is not going to do that well. So big household name companies such as Apple, Meta, and Starbucks have not only whiffed fourth quarter earnings estimates. Okay, I don't agree that they whiffed fourth quarter earnings estimates. They usually for the most part they beat out on terms of in terms of revenues and whiffed on earnings, but it was by a small amount. Honestly, none of these returns were as bad as I expected them to be, but most of them did offer cautious forward-looking commentary. As we see inflation decline and as we see cost-cutting measures going on in these companies, and by that I mean mostly layoffs, we're probably going to see improved quarterly returns going forward, but we're definitely not going to see that earnings per share growth that institutional investors want to see with those companies going forward. Where it's not going to be matching like 2020 and 2021. Okay, so earnings growth hasn't been there either. So the blended decline for the S&P 500 fourth quarter is at 5%, meaning that for the S&P 500 companies down in terms of earnings about 5.3%. And I think most of that is not going to be attributed to reduced revenue. That earnings decline is going to be attributed to increased costs of operation. And remember, a lot of what's on the S&P 500 has much higher variable costs than tech stocks do, meaning these are industrials that are dealing with a lot of increased costs on the production side. So if we look at market pricing for this year, it's not even pricing in a soft landing. I would agree with that. It's pricing in a takeoff. I would agree that it's not pricing in an earnings recession, which may be possible later on this year. Not a full recession where we see a contraction in GDP, but one where we see earnings really not keep up with expectations. It's pricing inflation to come down. It's pricing growth to avoid recession altogether, and it's pricing in central banks cutting rates beginning mid-year. That's where I think the big mistake is going to come is pricing in central banks cutting rates at the middle of this year. I don't necessarily believe that's going to happen. So what is he talking about when he says risk adjusted return? He's talking about something called the Sharpe ratio. The Sharpe ratio is something that I've never talked about on my channel, but I use all the time when I'm evaluating my portfolio as a whole, not necessarily through individual stocks. But it's very important to understand how money is flowing. So very simply put, the Sharpe ratio formula is a formula that basically gives you the expected return or the acceptable return for each given unit of risk. And that given unit of risk is defined by its standard deviation. So what is standard deviation? Standard deviation is basically everything within standard deviation of 7 means like if you have an average return over the last 10 years of 10% in a particular portfolio or particular stock, the standard deviation is 7. It means that 68% of your returns are going to occur within 7 percentage points of that average, right? So 68% of your returns are going to be within 3% and 17%, right? So if you have an average 10-year return on a stock of 10%, that seems fairly reasonable. But when you're looking at comparing to a risk-free return and then taking out that standard deviation when comparing to a risk-free return, it may turn out that you're doing better in a bond over that same time period than you would in the stock, even if the stock has a higher than average annual return because of how volatile it is. Meaning, if you're up 25% one year, right, you're down 50% the next year, and then you're up 25% for the next 3 years, you're still not, you may have an average return of whatever it is, but just actually going to be less than simply earning 4.5% every year compounding for that same time period. It's entirely possible to do that. And there are a number of examples out there online that you can take a look at. So the Sharpe ratio basically is the expected return of the portfolio minus the risk-free return divided by the standard deviation of the risk-free return. And this is a calculation that professional portfolio managers do all the time. Now, remember, a professional portfolio manager is not trying to give you the best return each year in their class. They're looking at the best risk-adjusted return, meaning how much return are they getting based on the amount of risk they're taking, and how is that related to the standard deviation, right? So we're going to go over a few things right now, and I'm going to show you that standard deviation right now for the indexes, the S&P 500 and the NASDAQ, are looking really, really bad. And some of that has to do with poor return last year, but more of it has to do with the rate of risk-free return right now being super, super high. And let's talk about how what that looks like by pure, of course, that action still here is the months. You should take those a second to come up, and it looks like there they are. So maybe too small for you to see on the screen here. Let me see if I can zoom in a little bit. Okay, so basically I'm going to take a look here. So a 3-month treasury right now is yielding 4.64%. A 6-month is 4.83. A 12-month is 4.84. And a 2-year is 4.47. So when you're evaluating portfolios and returns over that time period, these higher yields on the end and lower on the long are an indication that people think that interest rates are probably going to come down at some point and the stock market is going to do better. And that's what's been priced in for the future, right? But what you're competing against when it comes to building a stock portfolio is this this idea that you can get a risk-free return right now at above 4%, almost 5% at a number of different maturities. So if I plug this into a really handy Sharpe ratio calculator and I'm using the sort of 10-year return metrics for the S&P 500, over the last 10 years, the S&P 500 has averaged about 12.64%. Today's risk-free return is 4.85% on a one-year basis, meaning that the risk premium, what you need to earn over that risk-free return, is 7.79%, right? So I'm looking at averaging really close to that 12.64%. That's kind of what I need. If I look at standard deviation of 14.74, the Sharpe ratio on that index is 0.52. Now, it was actually negative a couple of weeks ago because of the return over time, and that's not useful information. Anything below, but a Sharpe ratio between 0 and 1 is not great, guys. A Sharpe ratio of 1 is pretty good. Between 1 and 3 is pretty good, and above 3 is really, really good. And I pulled these numbers from here, this is definitely too small for you guys to see, where I'm looking at the 1 month, the 3 months, 6 month, 1 year, all the way out to 30 years in terms of the return for the S&P 500. The U.S. Inflation adjusted return, of course, we got to throw that out because of the last year, because that's kind of screwed up the metrics over the 10-year. But when we're looking at the Sharpe ratio over time, we're going to take a look at this, what this looks like right now for the S&P 500. This is the S&P 500 Sharpe ratio over the last 10 years or so. This is the 1 mark, kind of where you want to be for having a satisfactory risk-adjusted return model here, meaning that anytime your returns are above this line right here, it means that you are likely to do better by owning a basket of stocks, that was specifically constructed to have this this Sharpe ratio above a 1 than you were in a risk-free, I think something like a bond. So, and as interest rates start to rise here, you see that that risk-free returns start to become more attractive. As they start to drop again in 2018, when we had a little mini bond crisis there, they drop close to 1, but they don't go below that. When we hit 2019 and fear starts to build that we are suddenly above, we're hitting the top of that credit cycle, that's when we start to see that risk-free return drop again. And of course, we have this the COVID anomaly right here. But last year, 2021, all the way through part of 2022, that risk-free return versus the S&P 500 calculation looked pretty good. It looked, stocks look like a good place to be for the future here. But we've seen this precipitous decline here in the last couple of months as we've seen interest rates start to rise and rise and rise. We got a little bit of an uptick here, but that looks like it's going to go down again once once the interest rate rise is recalculated back in. So this is actually even more acute when we're looking at what's going on with the NASDAQ 100. The NASDAQ 100 has actually spent more time above that 1 level over the last 10 years or so than the S&P 500 has, largely because technology stocks have done so well. And right now we're looking at negative Sharpe ratios for both the S&P 500 and the NASDAQ 100. What that means is that for many portfolio managers, rather than taking risks on individual stocks in, say, tech or something like that, they're probably looking at investing more of their portfolio mix into fixed income, which is actually going to artificially keep, on the low end, probably keep interest rates a little bit low. And that's really going to be due to market demand. And like, this is a phenomenon that's going to happen worldwide. So all of these pipe dreams about the US dollar are losing massive amounts of volume because of this, because of that, because we're printing money, that's all unlikely to be true, largely because of this. There's going to be an outflow of capital from professional money managers into fixed income this year. The fixed income market has come back to life, guys. And this may actually be the best case that I've seen being made, that really short article, just saying that take a look at Sharpe ratio for indexes right now and you'll see that the risk premium that you need to achieve to guarantee that you get more money over a risk-free return has to be pretty high at this point. When we're looking at an era where companies are facing cost pressures, they're not facing any pressures in terms of revenues. We are seeing spending still hold up, but they're seeing a lot of cost pressures. And honestly, that unemployment report that we had last week, where we had 500,000 new jobs created, that doesn't help. The two main issues right now that we have with inflation are wage inflation and rent inflation. Rent inflation has at least slowed down a little bit. Wage inflation has slowed down a little bit. But if this unemployment report from last Friday is any indication, that's of the market that's really out there, that's not going to serve to decrease wage inflation whatsoever. So I think that so I think that if you're considering huge investments right now because you believe that we've entered a new bull market, I would say consider dollar cost averaging your way in. I think that we're a ways off from a new bull market, and there's a couple of things standing in our way right now. First of all, that is uncertainty, geopolitical uncertainty over the war in Ukraine. We just don't know how that's going to go. Second is the debt fight. That's not even uncertainty. That's going to happen because it's largely political grandstanding. They're not going to allow the U.S. to default, but it's going to have a major impact on the stock market, and we're probably going to see some declines. And if you're dollar cost averaging your way into the market right now, rather than dumping everything in, I think that would be a great call. That is not to say that there aren't going to be outliers in the stock market that perform really, really well. But the outliers that you are looking for are companies that have an immediate pathway to profitability. So many of the stocks that I talk about on this channel have had this growth overall mentality, this growth at all costs mentality, which for the last couple of years has served them really, really well, where you're all dreaming for that day these companies turn profitable. So they're growing their revenue. They don't care about losses. They don't even pay attention to losses. It's all about growing their revenue. And one day they're going to be profitable. A lot of these companies are going to get caught out in the cold where their revenues are no longer increasing as fast as they were. Their costs are increasing more quickly than they were. What you are looking for now is companies that have a very short pathway to profitability and have had a way to cut costs significantly in the last year, whether that's from layoffs, whether that's just from reinvesting, whether that's from divesting themselves of unprofitable portions of their company, or like in the case of SoFi, where they have a structural change in the way they're doing business, and it's reduced the cost of capital for them by 190 basis points going forward. So they're basically making 0.19% more in terms of every loan that they're making right now because they're able to source their own capital from the increase in deposits at their bank, right? So that is a huge move going forward, and I think it's going to really help them achieve their goals of profitability in a really short time period. Companies like that I've covered in the past, like Upstart, they are now fighting an uphill battle where their cost of capital is increasing. They do have a little bit more in the way of spread in that they're able to offer the loans, but then they're not able to offload loans off of their portfolio, which they needed to do in order to keep the capital river flowing there. They need to borrow money through various different mechanisms, turn around and loan it out, and then package up and sell those and securitize those loans and sell them. So that securitization of loans is slowing down a little bit, and that's going to basically cause some capital constriction for them. They may not have enough money in basically enough capital to satisfy all demands for loans going forward, and they will likely become more restrictive in terms of their lending criteria in order to actually limit the number and risk of the loans that they're putting out. So this is a really dense discussion, guys, and I realize that this is not something that's covered very often in terms of Sharpe ratio. I should probably make a video just on Sharpe ratio, how to calculate it, why it's useful, and that sort of thing. I'm a little bit nervous about covering this on a live stream. I didn't know if there would be any questions on this whatsoever, but I really can't stress to you just how important this is. Portfolio managers, money managers right now are looking at the Sharpe ratio for the NASDAQ, Sharpe ratio for the S&P 500, Sharpe ratio for, well, not the Dow Jones, but look at and the Sharpe ratios of major managed portfolios, and they're saying, it may make a lot more sense to mitigate risk by buying 1 and 2 year securities when I'm guaranteed 4.8% return on those with no risk, rather than looking at maybe 7 to 10% return when the stock has a standard deviation of 14 or 20, which many stocks do, meaning that that 68% of returns are actually going to be somewhere between 14 and 21 points around that mean return. So for an example, if Google has averaged 21% over the last 10 years, I don't know if it has or it hasn't, but it has a standard deviation of 22. There's a very good chance that in this 1 year, you may actually see no return on Google, where you would see at least a 4.84% return on that 1 year bond. So a lot of professional money managers are going to be making this choice to basically mitigate the possibility of loss in this year, especially after getting burned heavily last year. On the flip side, of course, there's always going to be the money managers that were like, hey, we had a bad year last year. We can't always have, we need to position ourselves for the future here. So it's really a war of two different ideas. And I think that this guy is correct that the market has already priced in rate cuts at the end of this year. And I'm not sure those are going to happen. And I don't think, and he doesn't think they're going to happen. I'm definitely not sure those are going to happen. So, yeah. And I wanted to say hi to Shoeless Joe, Michael Will, and Tell 666-999. Shoeless Joe says, I've noticed some big supermarkets in the UK who made mountains of cash during COVID are suddenly making people redundant and complaining of hard times. For those of you that live in the United States, redundancies mean layoffs here in the United States. And we haven't seen supermarket chains here in the United States lay people off. But we have seen increased prices for a variety of different reasons. We have an egg crisis here in the western part of the United States, where eggs are like really, really expensive. Has to do with the avian flu wiping out a bunch of flocks. And I don't know if there's actually been large scale culls. I haven't looked into that. But we are seeing. I saw a pack of 18 eggs go for $10 the other day. That was a lot of money for eggs, folks. And eggs are something that I eat a lot of, so that's definitely very, very high. My wife and kids want us to get chickens. I keep telling them the prices aren't going to stay high forever, and that the cost of chickens for us would probably be relatively low cost. They've got plenty of fodder here on our property to eat. So, yeah. Let me see here. Google Bard is live to select users. All right. Let me see here. Michael says, let's hope the U.S. and U.K. give Ukraine so much defensive armaments that they deter any Russian spring offensive. Otherwise, there's going to be a Russian spring offensive. The only thing that will limit the Russian spring offensive is going to be the competency of the Russian military. I think that one of the big mistakes that when you're looking at, you guys have read, it's available online in a PDF. It's called The Russian Way of War. I think it was originally published in like 2011 or something like that. It was updated in 2016 and updated again in 2020. But you really need to read that to understand sort of the Russian way of war and just how they do things. And this isn't abnormal for how they do things. They don't fight for territory, guys. They don't fight for land. They level it. And this is just what they're doing. And this is why I've always said that I'm pleasantly surprised that the Ukrainians have fought this long and they haven't resorted to, insurgency tactics. But the outcome is still very much in doubt. I would say that the competence of the Ukrainian military is probably vastly overestimated. They're not fighting the way that the United States military would. That much I can tell you. What's going to happen? I don't know. I think that the ancillary effect that no one is anticipating right now, that I'm thinking about years down the future, is that Ukraine, regardless of what happens, Ukraine will be a massive supplier of mercenaries coming out of this. They are being trained and they're experiencing basically the entire world's military equipment. In any future conflict, they're probably going to be the largest single source of mercenaries anywhere on the planet for the next generation. And I think that's not something that's important really to my channel, but it's something that I was just thinking about the other day. Like, there's something like 13 or 14 different tank models are going to be provided to Ukraine in the next couple of months. There's been something like 16 to 18 different artillery types, rocket launchers, all kinds of things. Basically, they're getting experience with everything right now, and they are going to be a huge supplier of mercenaries. So anyway, questions about stocks, individual stock market, or individual stocks. I'm happy to answer those today. I do have a little bit more time here. Sam Alexander did a piece on egg prices. There's frog afoot. I paid Canadian $3.89 for a dozen large eggs. There's frog. So we paid. They've been like $5 or $6 a dozen. And I was in one grocery store, and it was on a Sunday. They were actually $10 a dozen. We didn't buy them then. We just decided to do without. But is there fraud? I don't know, because I haven't looked into this deeply enough. But markets do get cornered occasionally. So, yeah, Enphase. Any thoughts on reports tomorrow? So I haven't taken a look at Enphase in the last couple of months. It's been like 2 or 3 months I've taken a look at them, and I take a look at them every couple of months, largely because I have an Enphase solar unit on my my inverter, and largely because I haven't seen the hype around that being justified. So there isn't enough demand for solar installs right now to justify the hype. There could be in the future. That's really going to depend on what government incentives, like state government incentives, are given for people all through the Sun Belt in order to install it. Like, it's very cost effective to have solar in Southern California, largely because of how the industry is supported by the state in terms of tax receipts. I'm sorry, in terms of tax credits, and in terms of the net metering agreements that the state forced power companies to have. So it's been really effective at getting something like 26% of existing builds now have solar, and all new builds are going to have solar on them. But if you look at other states that are in the Sun Belt, like for example in Texas, it is not cost effective to have solar in Texas, because there is no help for that. They're not helping out the solar industry at all in that state. And they do have higher energy demands in that state than we do out here in California, but they have just as much sun. And I think that it would be a place where solar would do very, very well. But no, I have been looking at Enphase for a while and saying, does the is the hype really justified? And so far, I haven't really seen that it is. So I would be very interested in looking at their earnings tomorrow. And in fact, I don't think I've looked at them since their last earnings. And the last earnings, it was sort of in the middle of the decline of the stock market there, and it was kind of hard to see what was going on. But let's take a look here. Let's take a look here at so Enphase Energy. Let's take a look here and see kind of what the history of the company is. So yeah, it's roughly where it was the last time I looked at it. So $229 a share today. It's up a little bit in terms of earnings, positive earnings, which is good. Relatively volatile in terms of the general market, but price to earnings ratio is at 100 at this point. And this company's been around for a while. They're not new. I haven't looked that long. So they've really seen a huge increase in earnings over the last couple of years and revenues over the last couple of years, but they haven't seen an increase in earnings. Let's look at the last couple quarters. So they've beat revenues every quarter for the last 4 quarters, which is right. The reason I wasn't really excited about this company, the PDE was even higher, right? Price earnings is even higher. And when I'm looking at total addressable market in terms of Enphase Energy, the items that they produce right now, and how easy it would be for large, well-capitalized competitors to get into that market, and energy special, there isn't a lot of any of that. This is one of the reasons I was saying, I wasn't really a fan of ChargePoint. I wasn't really a fan of all these different like EV charging companies where you are going to have to make money off of volume in that space. You're not going to make money off of a unique technology. What they were actually selling, it just wasn't unique enough to have to make money off of volume. And I'm going to have to see an increase in earnings at this point, and like real earnings growth. So this is 3 years now where we haven't seen a ton of earnings growth. I'm hoping that full year 2022 is going to look, full year 2022, whatever their earnings was. They have we have seen a bit more in the way of revenues there, but I would say the price to earnings ratio for a company where the market hasn't really, we haven't really seen acceptance in the market nationwide. And most of the acceptance of solar has really been driven by people who are just environmentally conscious and people where governments have stepped in and made tax incentives really attractive for them. So at least that's here in the United States. If they have a much wider market that they're appealing to, like I don't know what they do in terms of international sales. So, all right. So we're going to take a look at another stock here. Sella Technologies. I've been hearing from friends. Let me see here. Catalan Divine says, what do you know about Excella Technologies? And I've been hearing that it could reach 50 cents. Why could it reach 50 cents? So earnings per share is at negative 85 cents. Beta is pretty volatile. It has a lot of volume in the last couple of days. So by that, I mean 4 times average volume in the last couple of days. So I'm kind of curious about that. So it's missed earnings the last 4 quarters. It's had declining revenues now for 4 years in a row. Earnings has looked a little bit better. It looks like they've gotten some costs under control. Let me see here. Medical coding operations. Okay, so Excella Inc. provides transaction processing solutions, enterprise information management, digital process services worldwide. Let's see, they operate in information transaction processing solutions, healthcare solutions, and legal loss prevention services. So company is $1 billion, right? This is a tiny, tiny company. The current price of the share is 6 cents. The 52-week range, it's been as high as $18 a share, and not sure why. And what would be the case for it going to 50 cents? If they radically cut costs and were a much larger step closer towards profitability, I could see them rise. Maybe some of the decline is really just everything going on last year. But when I look at their history of 4 years of declining revenues, right? 4 years of declining revenues, no profits in that time period. Look at the last 4 quarters where we have seen increasing revenue earnings misses every quarter in that time period. So and these are big whiffs, guys. Missed by $10.10, missed by $1.40, missed by $1.92, missed by 33%. So 33 cents. These are big whiffs, guys, not little ones. I would be curious to see actual case could be made for a long-term buy and hold on this. So definitely not a long-term buy and hold stock for me. Maybe if you're wanting to gamble on a Reddit fueled meme stock kind of run on this, then go for it. But this is not a stock that I would invest in, largely because especially when market cap is 8.865 million. I don't know what kind of cash they have, but if your market cap is only $8 million, it means you can't go to the market and you can't issue convertible bonds. You cannot issue, have like a secondary offering. There's no one's really going to put that out there. Let's take a look at financials here for a second. Let me see here. Yeah, it's a big gamble, Catalan. I would say it's a big gamble. Let me see here. Oh, let me see here. Cost of, oh, wow. Okay. Total revenue, billion, cost of revenue, gross profit. Let me see here. Look at the balance sheet. Take a look at the balance sheet here, and then I'll give you kind of a final, what do I think? Let me see here. Yeah, man, they're already at the end of, they're already, I would have to look at a current earnings, but it looks like they already have like significant debt. Um, yeah, it looks like they already have significant debt. They have negative working capital, um, total debt of 1.3 billion or so, and a market cap of 8 million. Yeah, I'm surprised they're not bankrupt as well. So, yeah, any thoughts on shipping companies now that China is in the process of reopening? I've started looking at the Baltic Dry Index and Genco. Man, so back when I first got licensed as a broker, I had come left and right buying these dry bulk shippers because they were paying like 9% dividends or something like that. And the stocks had gone crazy over the years. And every single one of those people like ended up like losing their rear ends on all of those stocks. The industry is structured quite a bit differently now. You're not going to see those giant dividends. You are going to see dividends, but those companies are going to plan on, and that was really not the beginning, but when globalization of the market in China was in full swing, and there was this incredible demand on shipping. We have a lot more in the way of capacity than we did back in that 2005, 2006 timeframe, when I was selling a lot of those stocks to people, or at least I was talking a lot of those stocks to people. The shipping industry has radically changed in that time period. We are looking at excess shipping capacity right now as China opens up. It reopens. I would say that the long-term prospects of we need to have a conversation about deglobalization at some point with each other. We need to have this conversation, about deglobalization, how that's going to work here in the United States. I don't want you to look at the Peter Zeihan thing and say everything's going to go deglobalized and all supply chains are going to be local. I don't think that, but I think most of our high dollar items, especially chips, are coming back to the United States. I think a lot of auto manufacturing is coming back to the United States because that labor cost differential no longer makes sense in China to a degree. So, so basically, vehicles that are made for the intended sale in China, for intended to be sold in China, will probably be manufactured in China. Vehicles manufactured for to be sold here in the Western Hemisphere will probably be made here in the Western Hemisphere. And that's going to happen with a lot of things that are kind of far up on that manufacturing chain in terms of quality, difficulty, and expertise needed to produce them. I think that's going to happen a lot, right? A lot of things that you buy in Walmart, a lot of things that you Amazon, that's not going to change. So I really don't see a huge spike in shipping for even if China is reopening. And like I said, we've never seen Chinese shipping completely cut off. What we've seen is individual ports being shut down a month here, 6 weeks at a time. Like wait times for ports, they're just completely down at this point. Do we think that demand levels are going to return 2020? I don't think so, man. It's not everyone staying at home, ordering things online anymore. So yeah, but yeah. So I don't think that it's a great opportunity there. I think, and I don't think it's a long-term hold. Let me see here. Michael Will says, can you look at ADM? Oh yeah, Archer Daniels Midland. Let me see here. And yeah, computer is slow again. So Archer Daniels Midland is a company that a lot of people haven't heard of, but it's an absolute stalwart on the New York Stock Exchange. It's basically a mega, not a mega cap, but a really large cap at 45 billion. If you looked at, for a company that's worth 45 billion, you only have 2,780,000 shares trading at a time. That's largely because this company is incredibly boring. Okay. This company was founded, I think, in the early 1900s They procure, transport, store, process, merchandise, agricultural commodities such as products and ingredients in the United States, Switzerland, Cayman Islands, Brazil, Mexico, all over the place. And a lot of what they're talking about is for this company could be positioned to do really, really well in the future. They pay a dividend of about 2.16%. Their earnings per share is right at 7.71. If I look at their 1-year chart, it hasn't changed all that much in a year. If I look at their max here, you're going to see pretty steady growth over a really long period. Steady growth over a long period of time. And let's remember that from 2004 to 1984, we saw that steady growth. It's been a little bit more volatile since then. But honestly, this is probably a really good long-term hold. If you are buying a stock right now, even though I think that they're going to benefit really well for the agricultural crunch that is coming in probably summer of this year and fall of this year, when people realize that we are not going to have the bumper crops this year that we did last year. Last year, Mother Nature was incredibly kind to us, and worldwide, people had bumper crops of just about everything. This year, it's just, I mean, it could still be really good, but I would be overjoyed if it was as good as last year, but I'm not holding on to that. This company, however, stands to benefit because of increased demand for a number of different things. And really what we're looking at is agricultural equipment trade. We're going to see a shift in agriculture in a lot of countries because Ukraine and Russia aren't going to be producing as much in terms of barley, and especially and rye as well. A lot of people forget that. But that is going to change. Seed oils, of course, as well. And so we're going to see kind of a shift in agriculture as people start planting different things. And Archer Daniels could be in the way of, could be a great benefit for that. Let me see here. So any thoughts on buying 1-year treasury bonds? Yeah, it could. And that's part of what I went over earlier here is that 1-year treasury bonds could turn out to be an incredibly good idea, especially if we go through an earnings recession. I think that that basically the market has priced in no recession at all at this point, and it's also priced in a couple of interest rate declines at the end of the year. A 1-year treasury is not going to be very sensitive to interest rate changes at all. It's not going to move that much because the maturity is shorter and shorter and shorter. The longer term your bond is, the more sensitive to interest rate changes it is, the more it's going to go. If interest rates rise, then that bond's going to drop in value. If interest rates drop, then the bond's going to go up in value. But the sensitivity to those interest rate changes gets heavier and heavier the further out you go on the time scale. A 1-year treasury is not going to be that sensitive to that, if it's sensitive at all. Even a 2-year treasury might turn out to be a pretty good idea. But I think a 1-year treasury is a good, safe bet where you're guaranteed to get 4.85% return. If you want to sell the treasury ahead of time because interest rates drop, then you might make a little bit more than that. If you want to hold it to maturity, you're going to make that 4.84%. If you want to sell it ahead of time, rates rise, you're going to make a little bit less than 4.84%. So I think that it may be a really good idea to do that. Bonds are something I don't have in my portfolio, but even I am tempted to do this largely because of how risky my portfolio is right now and how much money you can get on a risk-free asset. You can earn 4.85%, 84% right now on an asset that has no risk. So I think that is an absolutely, it's something thought-provoking to say the least, and you may want to consider doing that. And that's the calculation that a lot of folks are making right now when it comes to, do I invest in this stock or do I invest in this mutual fund? And look at the Sharpe ratios for mutual funds. A lot of them right now, because of the risk-free return, when they calculate February, not for January, when they calculate risk at the end of February, you're going to see that almost every mutual fund is far below 1 in terms of Sharpe ratio, meaning that the amount of return you get for each given unit of risk probably isn't worth it, right? And if your risk-adjusted return metrics may not look so great, you want Sharpe ratios on portfolios to be over 1 if you can. So, yeah. So what's the best way to invest in 3-month, 1-year treasury bond? I'm pretty sure that all of the apps will allow you to buy 3-month and 1-year treasury bonds. They will almost all allow you to do that. You can do that with any app here in the United States. I even had a discussion when I was in South America with people that could do it there. In South America, they were able to buy, and they bought a lot of U.S. Treasuries, largely because they had zero confidence in their own stock market and very little confidence in their own currency, and for very good reason, as it turns out, because inflation really hadn't. It was just starting to hit when I was there. And inflation hit really hard. And that guy, after I had that discussion with him about buying U.S. Treasuries, he was able to do it right in front of me on the beach, and that was pretty amazing. So I got to imagine that you're able to do that through, was it the trading 212 app or whatever that is in the UK? You should be able to do it through pretty much everything, and you could buy almost any country's debt on the market. In short-term debt from almost any country is probably going to be okay. Like buying Italian 1-year notes is probably going to be okay. Buying, Irish 1-year notes is going to be okay. So if we look at, I'm going to go to Kostin here. It's only going to look better than else's. Been far more of raising our interest rates. And in fact, other countries don't even have an inverted yield curve. Their yield curve is relatively flat, but it's not inverted like ours is. Like right now, short-term interest rates are higher in the United States than long-term interest rates are. Generally, most people just look at that as an indication that a recession is coming. But the reality is it's a lot more complex than that. It's not necessarily simply an indication. There have been a few times in history where the yield curve was inverted and we didn't have a recession. And generally, the recession comes 18 months after you see the yield curve inversion. So, all right, for some reason, I'm not able to pull my electricity. So I can tell you from memory, because I looked at like German and Italian rates today. They were in the mid 3s for like 1-year bonds. Internationally, that was Germany and Italy and Spain, and the United States on the short end is probably going to look better than anyone else. The UK may actually look pretty good, but a few months from now in terms of buying their short-term debt. But actually, I'm really questions about fixed income. I never get questions about fixed income at all, so I'm actually kind of really encouraged to see that. And yeah, so let me guys know. Let me know, you guys, if you have stocks. It's going to be a little more difficult to call. Yeah. The value here of a bond, you actually, if it's like a corporate bond, you need to know the actual CUSIP number. Corporate bonds on the short end too, you would actually get more interest likely on a shorter term corporate bond. But you'd have to look through those, something that's going to mature in less than a year or so. You don't generally get companies that are issuing 1-year bonds, right? Companies will issue bonds for 10, 20, or 30 years, and then you're buying on the open market after that if you know what the CUSIP is. So the CUSIP is just this long string of numbers. That's the numbers and letters. That's the individual identifier for a particular bond issue. And those are available out there as well. So one of the other things you could do, and this may work out better for you, is just buy a short-term bond fund. That might work out way better for you. Go for a short-term bond ETF rather than hunting for an individual security in that time frame, and you're probably going to get really close to that same amount of yield. And short-term maturities. So the answer: why do price on bonds go down when the yields are when yields go up? It means that new issue bonds have a rate, meaning that right now, if I owned a bond that had a coupon rate, meaning the interest rate on the bond was 5%, right? And on the long term, that bond has a yield right now of 3%. It means that I bought that bond for like $1,000 at par, right? And let's say now, because interest rates at 30 years are now 3.5%, right? So my bond pays out 5%. So my bond would naturally go up in value. Like if I sold it on the open market, I'd make like $150 on that $1,000 bond in capital gain, and because it pays 5% interest, right? So the price always goes up or down to match whatever the coupon rate of currently issued bonds are. So if you own a bond that was issued 2 years ago that has like a 30-year maturity, so it matures in 28 years and it's paying 3% interest. Now interest rates have risen up to that 3.5%. Let's say a couple of years ago you paid $1,000 for that bond. It's probably worth like $950 today. And that calculation is exact. It's not just the numbers that I'm throwing out here, folks. Like I'm just throwing numbers off the top of my head. Like if I actually wanted to sit down with a pen and pencil, I could tell you exactly what that bond is going to be worth today. And it may be trading, and when it trades over the par amount, which is the face amount, called beta. When it trades below that, it's traded at a discount. Buying a bond at a premium or a discount is immaterial. What you are looking at is the yield to maturity or yield to when you expect to dispose of the bond. Nobody buys a 30-year bond looking to hold that bond for 30 years. They're going to trade that bond in and out of their portfolio over time in order to maximize current yield and maximize the potential for capital gain, because there are capital gains associated with a bond portfolio as well. Traditionally, a bond portfolio has averaged something around 6%, right? Or the bond index has averaged something around 6%. That's for time. Sorry, bond portfolio is. So isn't there a 15% withholding tax on profits from bonds from non-U.S. residents? So the terminology is a little bit incomplete there. So profits on bonds means that you sold that bond for a profit, and that would be a capital gain, and you'd pay capital gains tax on it, which is 15%. Okay, so you would have to pay taxes on that. The 15% withholding tax on profits, like there's no 15% withholding on the interest that's paid on a bond. You would pay regular income taxes on the bond, regular federal income taxes on a bond. You would not pay any state income taxes on those bonds. So bonds can have different tax benefits depending on the issuing authority, meaning that most municipal bonds are actually exempt from state, local, and federal taxes. U.S. bonds from agencies and issued by the government are not exempt from federal tax. The interest isn't, nor the interest is not exempt from tax, but it is interest from state tax. It has to do with who issued it. So it has to issue with who issued. Basically, only the issuing authority can. It's long been held that only the issuing authority has the one to levy taxes on that. So if you're a UK resident and you own a bond on the U.S. market, I believe you're still going to owe taxes on that, but under your country's tax regimen, not the United States tax regimen. And it depends on how you hold the bond, on what you hold the bond. I don't know if you trade you company, you have accounts at a U.S. bank because you were once a U.S. resident or something like that. UK resident, not U.S. resident. So I don't know what UK law is in that respect, but you have to pay taxes on that somewhere. You'd have to pay taxes on it somewhere. And based on what I know of British tax law, you'd probably on it here than in the UK, right? Because our tax, especially when it comes to like capital gains, from what I understand, there really isn't a capital gains tax in UK. You pay regular income taxes on all of your gains. That may not be true. That's what someone told me, and I don't even know if I respect that person's opinion on tax matters. So, but yes, so that's basically the way taxes are here, and it's confusing. That if you make a capital gain on the stock, meaning you sell the bond, you sell the bond for more than you bought it for, and you've held it for more than a year, then you will pay long-term capital gains on any gain on that bond. Your interest, though, is going to be taxed at ordinary income rates, subject to a couple of rules depending on who issued it. If it's a state bond issued by the state, it's likely exempt from federal taxes. If it's a bond that was issued by the federal government, it's likely exempt from state taxes. And agency bonds as well. Like you could get like a federal home loan bank. There used to be these. Well, they still exist, but Fannie Mae, Freddie Mac, Federal Home Loan Bank, and there's a couple of other like agency notes that are also not taxed by the state as well. And so you perform like a tax equivalent yield calculation on those, meaning that if I buy this bond and I'm making 5% interest on it, and I'm not paying California state income tax on it, and based on my tax bracket, then yeah. Oh wait, okay, this is interesting. So most investors hold, and I say you can invest $20,000 a year, and gains are tax free. So most have an investment saving. You invest £20,000 a year, and any gain tax free if held to the end of the tax year, I believe. Okay. Yeah, one of these days I'm gonna have to look at all the tax rules associated with your retirement savings accounts over there. So you tell me you can put in $20,000 a year, and any gains you have are tax free as long as you hold the investment to the end of the tax year, meaning that you never pay any taxes on gains that are made. Interesting. I would want to go over there and get residency and open up an account there if I could then. But no, I thought that investment tax rules were fairly lax here in the United States in terms of if you have a Roth IRA, which you're limited to putting $6,000 a year in, but as long as you take the money out after 59 and a half, you never pay any income taxes on it either. So that's very interesting. But our IRA account, which a lot of people who are enjoying the benefits of a tax deduction today by putting money into their IRA, they will not actually be in a more advantageous position once they retire, largely because those middle tax brackets are so large and encompass so much of basically income ranges that, if you retire and you're in the 22% or 22% tax bracket today, and you retire 10 years from now, and you have a 401k, you have a small pension, or maybe you don't have a pension, you just have Social Security, you're likely still going to be in that 22% tax bracket. And based on how your account grows in that region, a higher tax bracket once you retire. Even you take out the fact that you're not paying, you're not paying any taxes on payroll taxes or anything like that. It may turn out to be that you're not more in the way of taxes. Anyway, guys, I have reached the end of my hour today. I do have to get going. I do have a few things to do today, and I do want to have to make time to hit the gym. I'm a little busy lately. I want to thank you guys for tuning in today, and I will see you guys on Thursday. Please go back and look at the beginning of the live stream. If you didn't look at it today, I was saying something that was pretty important about risk-adjusted return, where money might be going here for a lot of professional money managers in the next couple of months. Why we might actually be disappointed by stuff, even though things won't be as bad as we think, or won't be as bad as we imagine in terms of earnings. Why it might not matter in the end, and that largely has to do with the risk-free rate of return in terms of bonds is so high right now that it may be sucking investment dollars out of the stock market here in the next couple of months. Thank you very much, and I will see you folks next time.